Question: does your employer offer matching contributions to their employer-sponsored retirement plan, a plan such as a 401k or 403b? Do you know what the match is? How it works? Stay tuned. To make sure you are getting everything your employer has to offer, employer matching contributions, don't leave money on the table, coming up. It's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, go ahead and subscribe. And if you're watching this from the blog page of my website, fill out the contact form at the top of the page so that we can contact you when new content becomes available. So when it comes to employer matching contributions to your 401k, 403b, or the like, this should be a no-brainer. Your employer is agreeing to match your contributions to their employer-sponsored retirement plan, often dollar for dollar up to some limit. Basically, free money that is just waiting for you to claim. So why would anyone choose not to participate? Well, in my experience, there are a number of reasons, but the biggest is simply a lack of understanding as to how these matching contributions work. So in this video, I'm going to go over some matching contribution basics and give you the information you need to make sure you're not leaving any dollars on the table. So first up, you need to understand the rules of your employer's retirement plan. Employees can be excluded from plans such as a 401k if they do not meet certain requirements. However, generally, if you're over the age of 21 and have worked for the company for at least a year, you should be eligible. And once eligible, your company has a time limit as to how long they can make you wait before entering the plan, likely no more than 6 months. Once you are eligible and can participate, you're going to want to know if your company offers a match, and if yes, how much is it? You can expect a formula that limits their contributions to either a percentage of your income or a specific dollar amount. This might be something like they'll match your contribution dollar for dollar up to 3% of your income. Sometimes they're a little more complicated, say something like dollar for dollar up to 3% of your income and then 50 cents on each dollar up to 5%. In that case, of course, your maximum match would be 4%. However, you would need to contribute 5% of your income to receive it. So the important thing to know is this: what is the match formula your company uses, and how much will you need to contribute to get the maximum amount? In addition to a lack of understanding of the plan itself, another reason I hear as to why employees choose not to take full advantage of this basically free money concerns vesting schedules. This, of course, is some time period that an employer might require you to work for that company before some or all of their matching contributions truly belong to you. Leave before that time and some amount of money will be lost. Something I've heard clients say is, my company has a 6-year vesting schedule and I just don't see myself working there that long. Although this concern might have validity for some planning reasons, something to bear in mind is this: vesting schedules only apply to that money that your employer is contributing to your retirement account. Any money that you contributed as part of a deferral from your salary is not subject to vesting. That money cannot be taken away from you simply because you chose to change employers. In other words, not contributing to your employer-sponsored retirement plan for fear of losing money that you contributed is not a valid concern. Again, another reason I hear generally cited by younger clients goes along the lines of, I have my whole life to save for retirement. Why do I need to start now? Unfortunately, this is a huge miscalculation of the time value of money. I did a video on this very topic some months back. I'll put both a tag above and a link below. However, the gist of it is this. Imagine I had 2 employees who are both the same age and have similar professions. One starts saving at age 25, say $5,000 a year. After 10 years, they've contributed $50,000 to their account, but at that point, they stop saving. They just let the money in their investment account continue to grow untouched. The second person starts saving at that point, age 35, that same $5,000 a year. How long will it take for the balance in that second person's account to catch up to person 1? Meaning, assuming they never stop contributing that $5,000 a year, how long will it take them until they have as much as the first person who started a decade earlier, but who stopped contributing after their initial 10 years? Well, assuming both of these people get the same investment return on their money, the answer is forever. Person number 2 will never catch up. That's not to say if you didn't start saving immediately, you should just throw in the towel and give up, but it does mean the sooner you start saving, the better. Finally, one last reason I see frequently given for not contributing to an employer-sponsored retirement plan that offers matching money is, I have debt that I'm trying to pay off first. So how about this as a valid reason? Are you better off getting your debts paid down and saving the interest expenses rather than contributing to an employer retirement plan that offers a match? Well, of course, the first question is, are you able to make your debt payments? You can't allow yourself to become insolvent. You at least need to be able to make the minimum payments on your debt. Here again, though, this is a topic I've talked about before, actually just recently in a video I called The Truth About Debt. Always the equation is, does the interest savings exceed what you anticipate would be your investment return? Meaning, if I have some amount of money available to me and I have a choice to either pay off some debt on which I am paying, say, 5% interest, or instead invest that money in an investment that I anticipate would pay me a 7% return, it would make more sense to go for the investment than pay off the debt. In the end, that will result in the greater wealth. So what does this have to do with an employer match to your 401k? Well, if your employer is going to match your contribution dollar for dollar, that means you are guaranteed to receive a 100% return on your money. You could view that as an investment that is guaranteed to pay you a 100% profit. It's hard to imagine borrowing costs that are going to exceed an opportunity cost or guaranteed return of 100%. Again, you have to be solvent. You need to be able to make your debt payments. And here, you will also want to consider that vesting schedule on any matching money and the likelihood that you will truly receive those dollars. But this points out how valuable that free money is. Almost nothing supersedes the importance of maximizing this opportunity. For answers to questions about your employer-sponsored retirement plan, things like vesting schedules, investment choices, and how these savings fit into your overall personal financial strategy, I highly recommend you speak with your, hopefully, certified financial planner professional. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only. Not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.